When one of the most talked about politicians ever has their name on a stock, people are going to be interested in it. One of the 10 most searched for stocks in the world right now is DJT stock. That's Trump Media and Technology Group. I worked in finance for over a decade, and I've been investing for 2 decades, and I've never seen anything like this. Now, I did a cursory search for information on DJT stock, and what I found was rather underwhelming. It's not that I question the competency of trading Jesus or the stock analyst. It's just that I couldn't find anyone discussing whether this is a sound investment or not. So that's what we're going to do today. We're going to look at Trump Media Group and see if Joe Retail Investor has any business investing in this stock. But before we do this, let's start with what we know. So DJT stock started out as a SPAC. Now, a SPAC is a special purpose acquisition company, and it's another way for firms to IPO. The problem is that it skips the traditional IPO process, so you don't have competent institutional investors vetting these potential investments, especially when it comes to valuation. Now, back when SPACs debuted, we immediately warned about these vehicles, and they've done nothing pretty much but destroy value ever since. To make matters worse, Trump Media Group is an extremely hyped stock, so we can expect it to be volatile and overvalued. Now, since a very polarizing political figure has attached himself to the stock, it's important right now that you check your emotions at the door, because we're going to approach this as competent, experienced investors would. Now, I have no dog in the race myself. I'm not short or long. I'm just here to help you become a better investor. First thing to do here is understand what this company does. How do they make their money? Are they making money? Well, they certainly well should be. And if we go to the SPAC deck, so this is the glossy set of slides that every SPAC produced when they debuted their offering, and it's meant to sell investors on the potential of the company. So we can go back and look at what promises were made, and we do that quite often. It's important to hold management teams accountable for what they say they're going to do. So when we look at the Trump Media Group, we see various components of this enterprise, such as Truth Social, and they compare themselves to other large media firms, fair enough. And when we look at their aspirations, I always jump in the SPAC deck right to the meat and potatoes, which is how much money do you plan to be making by when? And you can see here that in 2022, they estimated $1 million in revenues, and then it just goes up from there. And you see in 2024, so we're already there, they're expecting over $800 million in revenue. So we're going to want to see how close they came to that target. But let's start first with the basics. So one of the nice things about SPACs is they all debuted at the same price, more or less. I think 1 or 2 debuted at $20, but the rest debuted at $10 a share. Now, very few trade above that these days. When we look at Trump Media and Technology Group, we see $30 a share. Okay, so that's trading at 3 times the SPAC price. What that means is that we expect to see fundamentals that match that. In other words, one would expect that they exceeded their promises to investors, and that's why it trades at such a rich premium. A couple other things to notice here. It's quite a large company, relatively speaking, at $6.6 billion. And there's a lot of volume here. Now, volume equals volatility typically, and you can look at this chart here from Yahoo Finance. I've sorted it by a 3-month average volume, and you can see a lot of talked about names. So volume often attracts people who invest in stocks, not companies. And by that, I mean that these are the sorts of people that will go and spout arbitrary price targets into the future without using any sort of valuation method to arrive there. Now, they're the type of people who dabble in astrology for men, or what's also called technical analysis. Now, when we look at how much money the Trump Media and Technology Group is bringing in, the results are rather disappointing. I had to check it twice because I was surprised at how low their revenues are. So last quarter, they brought in about $1 million, and that's slightly less than the same quarter last year. So that's not good. This equates to about $4 million per annum. This doesn't even pass our minimum threshold of $10 million per year, which we like to see from companies before we express any sort of interest. In other words, you have to be selling a meaningful amount of products or services before you actually have a business. Now, a couple other things to note here. Cost of revenue, it's quite low. So they have a fairly rich gross margin, but then when you look at the operating expenses, they're well over 24 times what the revenues are. So they're going to have to grow revenues rather quickly. And it's disappointing to see the trend is not moving in the right direction. So 2 things here to note. So this is a trailing 12 months revenues. So you see how they were for a little bit. They're increasing revenues rather rapidly, but then they went on a decline. You often hear companies say things like, well, in 2023, we increased revenues by 180%, as DJT stock has. But then when you look at the base they're working off of, it doesn't mean a whole lot, right? So the question that you need to ask yourself is this: what should a company with $4 million in revenues be valued at? So is it appropriately valued today? Things you want to consider. How fast are revenues growing? Well, we just looked at that. They're not growing at all, right? They're moving in the wrong direction. The faster revenues are growing, the richer the valuation a company can have. How profitable is the company? Now, of course, early on, tech firms aren't going to have positive operating margins. In other words, they're not going to be profitable. But you can always look at gross margin early on. That gives you an indication of the potential for profitability, right? What are other fast-growing companies valued at? That's very important. We look at that all the time. You hear analysts talk about price-to-earnings ratio, right? That's the traditional way to look at relative valuations between companies. But that's not going to work here, and it's not going to work for most disruptive tech firms because they don't have positive earnings. So we're going to use a ratio of revenues to size. And you can think about it like this. For the size of the company that you're investing in, what percentage of that market cap is reflected in revenues? So it's revenues per dollar of value that you're getting. In finance parlance, they call this price to sales or PS ratio. It's a very simple way to look at the valuation of a growth company. So I did a simple example here. So let's say I have a lemonade stand and I sold $100 in lemonade last quarter. Well, we can annualize that, multiply it by 4. So roughly it's producing $400 in revenues a year. Now let's say other lemonade stands in the neighborhood are valued at around 2 times revenues. Then my lemonade stand would be valued at what? $800. On average, exciting tech companies are worth about 6 times revenues. And you can chart this ratio over time. You can see here it's charted for a popular data firm called Snowflake, which started out trading rather rich, and over time it declined, and we actually use these metrics to gauge when is an appropriate time to invest. And for Snowflake, I think our cutoff was somewhere around 16 or something like that. And you can see when it dips below that, it actually works out fairly well. And making sure that you don't overpay for a company that you want to invest in. Another example here, NVIDIA. They're a little known company that makes AI chips. We've been invested in them for about 8 years now. And there's been ups and downs because tech stocks are quite volatile. But we can calculate price to sales. So we take their market cap, so it's $3,263 billion. They had $35 billion in revenues last quarter, so we can divide those numbers out. We get a price to sales ratio of 23. Now, we're annualizing, as I showed you in the lemonade stand example, we're annualizing the last quarter revenues. Traditionally, analysts will take trailing 12 months. They'll take the last 4 quarters, or maybe they'll take the last year, but we use the last quarter. We call this simple valuation ratio because it's more responsive. For NVIDIA, it's actually better to use price to earnings because this is a more mature company, but you get the point. So when we calculate price to sales for NVIDIA, we get 23. That's a benchmark. So a company that's growing quite fast, an exciting tech firm, to be valued at 23, that's actually rather rich because, as I said earlier, the average is typically around 6. So what's the price to sales for DJT stock? We can calculate that now. We understand how that works. Well, you take their $6.6 billion market cap, so that's $6,600 million. You take their last quarter revenues, which are $1 million. You multiply that by 4. You do the math there, 6,600 divided by 4, and you get 1,650. This valuation is objectively ludicrous. To be valued the same as NVIDIA, they'd need to be pulling down $71 million per quarter. So what you're observing here is meme stonk behavior. The basic idea is this: Joe Retail is ascribing whatever valuation he feels like to the stock. And this is what's known as greater fool theory. Now, we're not calling anybody a fool here. That's just what this theory is called. Now, I personally believe social media is the worst thing that ever happened to investors because it enables a group of speculators to promote stocks with impunity. And what happens is any notion of intrinsic value goes out the door. Now, I think there's several types of retail investors. When you look at the company's collateral, they point out that they have approximately 650,000 shareholders. They say with a unique profile, overwhelmingly comprising retail investors. And I think there's probably 3 types here. You have Joe Republican, who wants to show his support for his political party. And that's fair enough. Just be honest with yourself about this investment, right? You have traders or speculators. These are people who believe in astrology for men. And then you have Joe Retail Investor, who I think really believes two trains of thoughts. The first is a bad habit to get yourself into. It's, well, I'm playing with money I can afford to lose. Not a good idea, right? You're going to nickel and dime yourself to death, and you won't believe how quickly the returns add up when you're taking that money and speculative money and putting into less risky assets. And then I think there's the most dangerous situation to be in, which you have Joe Retail, who believes that this will eventually reap rewards. Well, intrinsic value wants a word with you, because the valuation that we're seeing here is so rich that for the firm to ever catch that up with fundamentals, it seems nearly impossible, frankly. Now, what needs to happen for DJT stock? They need to start growing revenues, period. Plans and $5 might get you a two-piece chicken at KFC with one side. So what is the company telling us today about their plans for growth? It turns out not very much. Now, you can go to their investor relations page. I pulled that up. It's rather sparse, and this isn't uncommon. Oftentimes we see firms that don't have investor relations teams, but in the most basic sense, you need an About Us page so people understand what management team is running the operation. An investor deck outlining some sort of master plan would be extremely useful. The only thing you have there really is that old investor deck from 2021. Quarterly earnings decks, aside from just a press release, a PowerPoint, some slides, can help us see more clearly what direction the company is going in. But what that means is we need to start poking around the SEC filings to see what they're up to. And I pulled this press release here, rather recent, talks about how they have the company's content delivery network is the technological backbone of its new ultra-fast TV streaming platform. That's great. And they've got all these big plans. Always look at what sort of progress is being made in terms of revenue growth, and don't listen very much to the stories being spun by management. That's just never worked out well at all in the history of investing. But one thing I noted here that's good, they have nearly $700 million in cash and no debt. But remember this, it's not uncommon for us to come across firms that actually have a market cap less than cash. So essentially, you're getting a free business. Why is that? People are quick to jump on that, say there's value. Not necessarily. It's because the market doesn't believe that they can actually take the cash they have and turn it into more cash than what's on their books, right? So when we look at cash flow, you want to pay attention to that in any company that's not profitable. We see what last quarter they burnt around $22 million. You divide that out by 700 million. They have roughly 8 years of runway. They can probably sell shares that are rather rich. Mr. Trump, I think, owns 58% of this company. Of course, if he goes to sell, that's going to send a bad signal to the market, but they can always issue more shares, sell them, raise more capital. People will say things like, well, if you're so sure this is extremely overvalued, then why don't you short it? Well, first of all, there's no free lunch, and that's, I think, after decades of investing, I've learned that there's no obvious bet in the market, so we just don't go there when it comes to shorting. It's a horrible idea. Even sophisticated institutional investors can blow up their accounts, as we've seen in the case of meme stocks. I'm sure people are asking things like, well, what does the incoming administration mean for DJT stock? And that's certainly going to be a part of the bull thesis. Well, when you look at what sort of growth they've been experiencing, it's not very much. They talk about, from 0 to 9 million signups on Truth Social as of mid-February 2024. Well, when you go run those numbers against a firm like X, daily usage, you see what X has 238 million daily users. They're back in 2022. And then you look at Truth Social. This is taken from CNBC. And I'm fully aware that the media is going to be biased in a lot of cases. So that's why we wanted to put out this video, to give you an unbiased look at this company. But they're just not hardly doing any traffic, about 0.03% of X traffic, at least based on these numbers. So thoughts on DJT stock. Until there's $10 million in revenues per annum, they just don't have a viable business. We don't invest in a price to sales greater than 18, or for our regular readers, what we call a simple valuation ratio. DJT has a price to sales of 1,650, maybe the highest I think that I've ever seen. To put that in perspective, if DJT traded at the same price to sales ratio as NVIDIA, they would be trading at about 42 cents a share. We need to see strong revenue growth, and we need to see it really soon. And no, we're not short. We don't care what the stock price does. And we're not interested in the thesis. It's very difficult to displace large media companies, and we don't see DJT making much traction in that respect. Now, there's, around 650,000 retail investors who might be watching this video and could use some guidance going forward on how to accumulate wealth. And I think if you want to make money, you need to get to that first $100,000, and we've done a piece that describes just how you can do that. Make sure to watch that next. Thank you so much for taking the time to watch this video today.